Hi friends, today we are going to see how to evaluate that insurance company because in another 3 days, that is coming Wednesday, the LIC IPO going to be open. So it is very right time and very important to know how to do the evaluation of the insurance company. Welcome to our channel Stocks and Silence. First, let us see how the insurance penetration in India. First of all, we should understand what is the penetration rate. Penetration rate is nothing but the measure of the ratio of premium underwritten in a particular year to the GDP. This also many people don't know what is the penetration rate. So please understand it's a ratio of premium underwritten in a particular year to the GDP. Now let us see the graph. Now if you see the graph, there are two types of insurance. One is non-life, another one is life related. If you see the data for last 20 years from 2000 to 2020 to 21, last 21 years, if you see the data, the non-life insurance is almost 0 to 1 percentage, that we can call it as a 0.75 to 0.8 percentage. It is almost flat, but at the same time, if you see that life, that is a blue color, that is comes around 2 to 4 percentage, altogether total around 4.2 in last year financial 2021. So this graph, what we are understanding is all togetherly total life as well as the non-life, the penetration ratio is 4.2, life related 3.2, and non-life is 1% for the last financial years. Now we know that what are the insurance company in India. More than 30 years that LIC is playing the major role in the insurance in India. So they have the NBP, that is market share of NBP, new business premium market share for the financial year 2022. If you see, the LIC is a 61.2 percentage. They are the major player in India. The next one is SBI Life. They are in second position, 9.1 percentage. But if you see the gap between the number one and number two, almost six-fold higher than the number two. The LIC still is a major player in India. The third place is HDFC Life, that is 8.4 percentage. Fifth one is ICICI Prudential, 5.1 percentage. Then sixth position is Bajaj Alliance. They are in a 2.9 percentage. They are in a fifth position. Sixth position is Max Life, 2.6 percentage. Seventh position is Aditya Birla, 1.9 percentage. Eighth is Kotak Mahindra, 1.8 percentage. The last ninth position is Tata AIA, that is 1.7 percentage. So what we are understanding here is, we know everybody in India, this LIC is a major player in insurance business. Now, how to evaluate those insurance company? Because it's not like other company. The other company like automobiles or any FMCG, we can understand how many products they have prepared, how many sold, and what are the profits, what are the margins, and what are the taxes, what are the liabilities. So easily we can understand the balance sheet. But in case of bank as well as the insurance company, slightly different. But if you go for the bank, always we are seeing the asset quality, provisions, and then CASA ratio, all things we are seeing in the bank. But that is also not in the case of the insurance. So how to understand? Because that business itself is having a lot of complications. Let us see one by one what are the complications. The main thing is, if you see, they are running through the long duration of the contracts, because if any policies, they have to give a long contracts, for example 5 years, 10 years, 15 years, 20 years. So the contracts is always depends on the future, and again the long duration is there, that we don't know how much policy holders will continue or will wait to the maturity time until 15 years or 20 years. So inherent uncertainty is there in this business. Second one is, as a policy holder, they have to give that minimum some guarantees to the policy holders as a organization. For example, if it is LIC, they have to give some minimum guarantee to the policy holders, like when if some death or something happen, what is the minimum guaranteed rates, when they can able to give. So those type of guarantees they have to give. Third one is, they also falling under the financial risks or the financial cycles. For example, if it is interest rate is hiked, or equity returns, or inflation, so those all will affect this business also. Apart from these financial issues, non-financial issues also there in this business. For example, mortality, some policy lapses, or some other expense, or sudden some pandemics and lot of claims may come. So those are all called it as a non-financial area, that also risk is there in this business. In addition to that, depends on accounting practices, because this business is not like other business accounting practice. They are deferred in terms of acquisition costs and then IFRS accounting. So those are all totally different from the other business. So in terms of guarantees, in terms of financial and non-financial risks, in terms of accounting practices, and then all depends on the future policyholders beliefs. All things are, these are all the inherent complication in this insurance business. Now let us see how to understand that. There are four major, we can say, the way of or methodology to understand this type of insurance. The first one is embedded value, that we call it as a EV. The second one is value of new business margin or value of new business. Generally, we call it as a VNB margin. That is also one of the key factor to understand this insurance business. Third one is persistency ratio. This also very much important. The fourth one is solvency ratio. These four category will give better idea to understand how this business is running well or whether it is going a loss or profits. This will give the better idea. Now let us see one by one how this value and how to do that. First, the embedded value. Embedded value is nothing but the addition of adjusted net asset value plus value in force. If you total together A and AV, that is adjusted net asset value plus value in force, that we call it as embedded value. Or the A and AV come from the net asset value and liabilities plus assets. All together we call it as a balance sheet in this business. So how to calculate A and AV? This is nothing but company's published net assets adjusted to the reflect to the market value of the related backing assets. So it's slightly different from the normal mutual fund NAV. Here we call it as a adjusted NAV. That adjusted NAV, in addition to that value in force, that is called value implicit in the contracts already in force. For example, they have some contracts, those are all already in force. Those if you add together, that we call it as a embedded value. So embedded value is slightly or simply we can say the net asset value and the discounted value of profits from in force policies. So if embedded value is good, that is a good for this company. Now let us see what is the embedded value of the insurance company which are available in India. Particularly if you see the LIC is around 5,397 billion as of now. The next line is SBI Life 353. Third one is ICICI Prudential 302 billions. Fourth one is HDFC Life 287 billion. The last one is Max Finance Service 130 billions. So when we if we see that embedded value to the peers, still the LIC is a very good value, that is around 5,397 billion. It looks good, attractive, but at the same time, if you see the P by EV, see how we are calculating the P by E ratio for the simply normal stock. In insurance, we call it as a price to embedded value ratio. When we see that ratio, it is 1.1 times higher. That is, LIC is still cheaper when compared to SBI Life, that is 3.1 times, and HDFC Life is 3.9 times higher. So it looks like LIC, the embedded value is high, but at the same time the P by EV ratio is low, so it is little attractive when compared to HDFC Life and SBI Life in terms of price. Now the next category what we discussed is the value of new business margin. We have seen that value of new business margin means here how they will get that new business in terms of policies and in terms of modification of new type of policy holders or new policies, that we call it as a new business margin. How to calculate it? This is simple. The formula is there. Value of new business divided by annualized premium equivalent. We call it as a APE. So how much value of new business comes divided by annualized premium equivalent, that we call it as a VNB margin, that is value new business margin. This is very much important to understand the margin of this business, because this only going to give in the upcoming years whether 10% or 15% or 20% margin they are going to get or not. How they are calculating? For example, if you say the VNB margin is 20%, would mean that if the insurer underwrote a new business premium for a particular product, consider say worth rupees 100 rupees for the particular year, then the expected profit over the lifetime of that business is rupees 20. So that's why we call it as a 20%. Okay, so now the second parameter, the VNB, is major important. Companies with high VNB margins are good from a profitability point of view. The third one is persistency ratio. The name itself, it indicates that how much policyholders can withstand over the long period of time, how many customers persist with their policies with this particular organization, that we call it as a persistence ratio. This is an important metric to track, as persistence is a key driver for the profitability of the particular insurer. So now if you see, the global average of 13th month persistency is close to 90%, whereas the 61st month persistency is about 65%. What is that meaning? 13th month and 61 month. It's nothing but nothing. 13th month is just nearly 1 year. 61 month is almost 5 years. So the policyholder is going to be stay for 1 year, or if you see the data for last 5 years, the range is 65%. Means, for example, for better understanding, suppose if I say the 61st month the persistency ratio is 50%, that means in 5 years 50% of the policyholders they surrender, they have gone away from the organization. That is why the persistency ratio is just 50% in 61st month. So always this also is an important factor to understand the performance of the insurance company. The persistency is an important metric to consider while evaluating stocks of a life insurance company, and should compare with the global benchmarks. The higher the number of years the policy continues, higher the profitability. So of course the persistency ratio should be higher, then only we can understand they have many policyholders and they have a good potential to grow. Now this is also one of the important things. Can we understand that profit and loss? Because we have discussed about that persistency margins and new business margins and all, persistency ratio and new business margin. But in this business, slightly we have to understand this is nothing related to that 4 category, but at least we have to understand that because it's related to insurance. Let us see the example 1. If profit and loss high but value is destruction, how? See, for example, there are thousands policyholder, they could not able to pay the policy, then the policy will get lapse. It's a good for the company, it's a short term, but at the same time the value of the company will lose after over the long time. So it looks profit but value destruction. This is the case 1. Same way the reverse case also there. Here they are getting the new business and the new acquisitions, because of that they may show as a losses, but with a long period of time it's not a loss for the company, it's a value creation for the company. The case 1 in short term shows profit but long term shows destruction. The second case, the short term shows the loss, but over the long period of time it gives the very good profits of the company. So what we are understanding is profit and loss for the short term we could not able to conclude in this business. Next one is the solvency ratio. I think this is the last one in this last 4 category. Solvency ratio defines how good or bad an insurance company financial situation is and defined solvency norms. What is solvency norms? This is nothing. According to IRDAI, that is the Insurance Regulatory and Development Authority of India guidelines, all companies are required to maintain a solvency ratio of 150% to minimize bankruptcy risk. They have to maintain at least 150% solvency ratio as per the guideline of IRDAI. Then how they are calculating? Simple. The amount of available solvency margin, we call it as a AMS, amount of solvency available solvency margin, is relation to the required solvency margin. Simple. How much they have or how much they have to pay back to the policyholder in case of emergency or in case of claim. So that ratio they calculating is a solvency ratio, that should be always 150 times higher for all the company as per the IRDA rule. So obviously it is understood that if solvency ratio is high, then the organization in good conditions, they are in good shape to settle their all claims or whatever it is. So finally, Now let us see the global comparison of the LIC, and then what are the insurance company in India. When compared to the Indian insurance company, how LIC is best or bad, or let us see based on the data. Now we are aware that government is last 1.5 year they are trying. Last February itself they have announced. Now let us see the globally their market cap is for LIC $78.47 billion. In dollar I am saying it's the fifth largest when compared to all insurance company among the world. The first one is Ping An Insurance. They have the market cap of around 118.99 billion. The second one is AIA Group 115. Alliance C-Reg, that is a third 94.4. Fourth position China Life Insurance 89. Then near to that was LIC 78.47, that is in fifth position. Sixth Zurich Insurance, Aksasa, they are in seventh position. But overall what we are understanding is based on the market capital, LIC is the biggest one that everyone knows. Even globally we are in fifth position for the LIC. But if you move to the embedded value, LIC is far better when compared to others, because other companies embedded is starting from 0.5 to the maximum Zurich is 1.74, though government has planned that embedded value should be in between the minimum and maximum when compared to the global insurance company. In that way that is the LIC embedded value is 1.11 as of now. But at the same time PE is very high, 129.22 when compared to global. But just now we have seen this LIC, the embedded value is good, but at the same time here it has given us a PE ratio, but normally we have to calculate P by EV, that is price to embedded value ratio. In that way the LIC is cheaper when compared to HDFC Life and others. When we see that Indian insurance company, the market capitals, it has already know that. The next one is 15.17, that is HDFC Life. SBI Life 14.31, almost near to that. ICICI Prudential 9.83, Max Financial 3.4, embedded value for HDFC Life 4.05, SBI Life 3.1, ICICI Prudential 2.5, Max Financial 2. So overall it looks better and we are in fifth position. The value wise and the price what we are going to give for LIC is little cheaper, but how the business is running when compared to HDFC Life and all that we are going to see one by one. Now the IPO is going to come. Let us understand that assets and net premium, net profit for the LIC. Financial year 2020 it was 34.14 lakhs, then 21 37.46 lakhs. Now in 2022 near to 41 lakhs as a total assets. Net premium is decreased. Yes, it is decreased from 3.8 lakhs initially, then again 4 lakhs, then finally it become 2.8 lakhs in financial 2022. That is notable point. The net premium is decreasing. Net profit also decreasing. It was 2,710 crores in 2020. 2021 2,974, but in 2022 in last 9 months it is just 1,714 crores. This also we have to be noted down here. The net profit is decreasing in LIC. Then one more data we should see quickly, the APE, that is annual premium equivalent, we call it as a EPE premium. Financial 19 is 40,565. It is decreased to 18,448 in the financial year 2022. So the annual premium is decreasing in LIC. Same way the APE growth rate, if you see, that is also become minus 19.1% when compared to financial year 2020. It was 18.3 plus, now it is minus 19.1%. VNB value of new business, that is also decreased from 21 to 2022. 21 it was 4,161, 22 it become 1,583. VNB margin also almost decreased, 9.9 it was there, now it is 9.3 in financial 2022. So overall if you see based on the APE premium, APE growth rate, VNB margin, all are in downside only. Persistency ratio somewhat better, because you can say 79 was there in last year, the same they are maintaining this year also 79%. Then persistency 61st month, that we have seen that after 61st month, that means after 5 years how it is. So last year 59, now it is a 61, better, no issue. Embedded value we have already seen, that is keep on increasing for the LIC. Now we'll compare how the business to the other peers who are in India. The major one is SBI Life, HDFC Life and ICICI Prudential. But if you see the graph, the one, there are different colors as given, but only two major colors for LIC. This looks, majority of the policyholders are PAR, that is participations policies. But when compared to other insurance companies like SBA, HDFC and ICICI Prudential, they have many non-PAR policies, ULIP and protections and annuity and then group policies. Those are all more when compared to LIC. LIC is 60.7%, majority of the people are in PAR, that is participative. So that it's a negative point for the LIC, because over the long period of time the multi-type of business is required, multi-type of policy also required. In such a way the other people are in good shape when compared to LIC. The same it's indicating the downside graph. The light blue color is for the other private companies and the dark blue, the navy blue, is for the LIC. But in the year of 2015 it was 51%. It keeps on decrease from 2015 to 2022 from 51 to 37%, almost 38% for the LIC, which means the retail APE market share in financial year 2022. APE means annual premium equivalent, that is the people who paid every annually, that people are decreased. They may be surrendered or they may be lapsed or whatever it is, but particularly for the LIC it's keep on decreasing from 2015. But at the same time, the same year from 2015 onwards, other private companies are keep on increasing. They increased from 49% to 63%. This is very notable point. So now let us come back to the IPO. IPO is going to come on May 4th, that is coming Wednesday. 9th will be closed, 3 days time period. Then basic allotment May 12th and the refunds initiation, those all on May 13th. Then 16th it will come to a demat account and IPO listing date is 17th. So minimum lot size is 15 shares. The price range would be around 900 to 950, maximum 950 rupees. The one lot would be 15 shares with amount of 14,235. Maximum lot size would be 14th, around 210 shares for retail participants, and it will be around 1,99,290 rupees. So this is normal slots, and what we are understanding, the price is around 900 to 950. One lot size would be around 15 shares you will get. So we have seen what are the parameters, how to evaluate, and what are the negatives and what are the positives. Quickly once again we'll see, particularly for the LICs, what are the positives. They are the leading insurance provider company in India and fifth largest global insurer. Second, the range of life insurance products to meet the varied insurance needs of the individuals. Yes, they have the variety of products. Third one is strong omni-channel distribution network. They have 1.34 million agents, 3,463 active micro insurance agents, and 174 alternative channels. Of course, they are the first in India. They are working more than 30 years in India, so they have a very dedicated channel, so many agents. That is the biggest positive point for them. And largest asset manager in India with an established financial performance track record. Of course, everybody knows they have a lot of fund, highly experienced and qualified management team. This is also a very good positive point for this LIC. Now we will see what are the negatives. Negative point, we see the lower attractiveness of recalibrated PAR products. We have seen the graph when compared to other insurer. They have apart from PAR, they have other products also, but majority 60% of the product in LIC are PAR products. That is a negative. Lower persistency and higher surrenders, that we have seen the second graph. After 2015 many people is surrendering. That is a negative point. Possibility of anticipated intensity in mortality claims due to ongoing pandemic. Yes, this is unexpected. In pandemic many people, they are expecting claiming that mortality claims. That is always expected, not only for LIC, it is a negative point for any insurance company. Sharp fluctuation in interest rate leading to change in embedded value. Of course, that interest rate is going to be hike globally due to the inflations. That will alter that embedded value, no doubt. Inability to retain and recruit individual agents. That is one of the negative point, because the agents are not retaining for a long time, they keep on moving, so could not able to retain. And in, of course, in future, if they are coming as a company, then there may be the chance to form a union, and then it may slow down their process, and then they may demand for the salary hike. So those type of process may comes in the future. That is all negative points. Now let us see what is the embedded value of the insurance company which are available in India. Particularly, if you see, the LIC is around 5,397 billion as of now. The next line is SBI Life 353. Third one is ICICI Prudential 302 billions. Fourth one is HDFC Life 287 billion. The last one is Max Finance Service 130 billions. So when we sorry, if you see that embedded value to the peers, still the LIC is a very good value, that is around 5,397 billion. It looks good, attractive, but at the same time, if you see the P by EV, see how we are calculating the P by E ratio for the simply normal stock. In insurance, we call it as a price to embedded value ratio. When we see that ratio, it is 1.1 times higher. That is, LIC is still cheaper when compared to SBI Life, that is 3.1 times, and HDFC Life is 3.9 times higher. So it looks like LIC, the embedded value is high, but at the same time the P by EV ratio is low, so it is little attractive when compared to HDFC Life and SBI Life in terms of price. The third one is persistency ratio. The name itself, it indicates that how much